We want to bring in Nouriel Roubini, professor of economics at NYU's Stern School of Business, also CEO of Roubini Macro Associates. We're also joined by Yahoo Finance correspondent Julia LaRoche. Nouriel, it's great to have you back on the program here. Let's start with Bitcoin, because the last time you were on with Adam and Julia, you were talking about Bitcoin and you were saying you were very skeptical of it, that it has no fundamental value. So I'm curious just to get your take on the massive rise that we've seen since then and why we're seeing so many investors bet on Bitcoin.
Well, there's a massive rise, but there is a huge amount of volatility. You know, overnight it fell more than 12% and now is down 7% for the day. And you have to ask yourself whether retail investors and institutional investors should be investing into something that is so risky and something that is not a currency and is not even an asset. I think it's volatile. I think that some of the movement upward is driven not by worries about inflation or debasement of fiat currencies, because gold is not going up very much. Tips are not going up very much. Why would just Bitcoin be a hedge against inflation and debasement of fiat currency? There must be something else. Something else is that there is massive manipulation. We know there are pump and dump schemes, there are wash trading, spoofing, there is front running even by exchanges. And there is this phenomenon of Tether, a stable coin that is produced out of nowhere with, we don't know which kind of backing. And every other day there's $1 billion of it issued that goes to buying Bitcoin. So I think there is massive price manipulation. There are a bunch of whales and insiders that are manipulating this market. And we know there are a whole bunch of legal investigation by the DOJ, by the CFTC, by the Attorney General office in New York that are looking into what's going on. So I think it's a very risky asset class.
Nouriel, it's Julia LaRoche, and you're mentioning some of the whales who are in the space, and you believe it's a risky asset class. And I think the last time we did speak, you said that, look, this thing has no place in an institutional investor's portfolio or a retail investor's portfolio yet. We've seen a lot of retail investors in this space. We have seen a lot of big names, very well-established names, enter this space. So, like, why not? Why not have even the tiniest little percentage allocation in Bitcoin? What is the argument against just having some exposure?
Well, there are some people that are risking their entire house on it. I mean, if you take Tesla, if you exclude the credits that they get for gas emissions, it's still a money-losing firm, and now they're betting all their entire cash on Bitcoin. If you want to become a Bitcoin fund, be a Bitcoin fund, but not an electric vehicle company. Or MicroStrategy is a tech firm that was flat for 10 years, didn't go anywhere, pretty much, and now the CEO is betting the entire cash and borrowing a $600 billion on Bitcoin. So you're not a technology company. There are people who are doing lots of risky stuff. You know, the people are institutions. Everybody wants to trade the stuff. Everybody wants to be custodial, because regardless of whether it's worth 0 or 50, they want to make money out of the trading. It's not as if Goldman Sachs or the custodians believe in this asset class. If you can get a cut out of the exchanges in the crypto space, so be it. And, you know, institutions are weird. You know, Scott Minerd from Guggenheim Partners one day says, we're going into Bitcoin because it's going to go to 400,000. And the next month he says, no, it's going to go down to 20,000. Just make up your mind. The reality is that nobody knows what the value of this pseudo asset is. It doesn't have any value because it doesn't have any income, doesn't have any use, doesn't have any utility. So it's a total speculative play on a bubble that is self-fulfilling. And now we have, like in 2017, hundreds of thousands of retail suckers that are having FOMO, fear of missing out, going into this asset class. And they're going to buy at the peak like it happened in December of 2017 when Bitcoin was 20,000 and it fell to 3,000 by the end of the next year. So it's the same phenomenon,
Nouriel,
just people moving in because of FOMO, feeding the bubble, manipulation, and eventually there'll be a crash. I mean, overnight, 12%. Which asset class has that volatility?
Let me just keep this simple, because a lot of us, we get moved by the big sway. Fortunately, I don't have $50,000 to buy a Bitcoin, so I'm not at risk, but you could do a fractional, you know, you can buy a fraction of it. Is there any purpose for Bitcoin? I hear you dismissing it, but I think I'm missing something.
Well, an asset, usually stocks, bonds, loans, real estate, they give you income, and therefore there is a reason for the capital gain if the dividends are not fully rebated, the profits. Other asset classes like real estate, residential, gives you housing services. You know, gold doesn't have income, but has uses in industry, as utility, as jewelry, and has been used for liquidity purposes and as a store of value for thousands of years. So you're asking yourself, what is the fundamental value of Bitcoin? Doesn't have any income, doesn't have any uses in industry, doesn't have any utility. You cannot have a gold chain of Bitcoin, doesn't give you any pleasure, unlike gold and jewelry and other stuff. And therefore doesn't have any intrinsic fundamental value because it's not even scalable. You can do only 5 transactions per second with Bitcoin, while you can make 24,000 transactions per second with the Visa network. So it's never going to be able to be even a means of payment. And it's not a unit of account. It's not a single numeraire. So people say it's a store of value against tail risk. But when in February, March of last year, US stocks went down, say 35%, Bitcoin was not a hedge. It went down by 50%. And other cryptocurrency went down by 60%. And if it's a hedge against inflation, what's the fundamental value that leads it to be a hedge against inflation? And if people are so worried about inflation, why Bitcoin goes from 5,000 to 50,000 while gold has been correcting downwards and break-evens are barely above 2% and tips are giving you returns are still relatively mediocre? If people are really worried about inflation, they will diversify in a wide range of assets that are historical good hedges against inflation. That's not happening. So that might not be the reason why Bitcoin is going higher. So it must be manipulation. There's nothing else that explains this movement.
And Nouriel, as we talk about the U.S. economy, some of the people whom we serve at Yahoo Finance would say the yield on the 10-year bond is now approaching 1.4%. Another group of the people we would serve would say 10 million of our fellow Americans are still unemployed. Which would you be looking at as a measure of where we stand in this economic recovery?
About an overheating of the economy based on the fact that we have massive monetary and fiscal stimulus, that we are controlling the contagion, that we're going to have vaccines deployed, that financial conditions are easy. But I'm not sure about the overheating because studies suggest that out of the $1.9 trillion of the fiscal stimulus, most of it is not going to be spent, it's going to be saved because there are millions of households that are in arrears on their rents, on their utilities, television, cable, phone, gas, electricity, or they're not paying their mortgages or personal loans or credit cards or student debts. So out of the 1.1 trillion, I think at best 1/3 is going to be spent and the other 2/3 is going to be saved. If that's the case, then the growth impulse of the stimulus is not going to be as large. Secondly, the money that is recycled through savings is going to end up into treasury bonds and therefore is going to cap how much those treasury yields are going to rise. And 3 is going to be a bailout not only of households, but also of credit markets, of banks and all the financial market credits that have lent to the households that are now under stress. So I think that if I'm right about this inference, we're not going to get overheating. The bond yields are not going to rise furthermore. We're not going to have in the short run an inflation burst. And we'll have a bailout of household that becomes a bailout of the credit markets that have rallied a lot, but they will have room to rally more than otherwise.
So Nouriel, correct me if I'm wrong. Am I hearing you on this? So the $1.9 trillion stimulus, you don't think that's going to be excessive? If so, can we explore that a bit more? And also the implications, you said, 1/3 of it will be spent. Most of that will be saved, and there'll be some that goes into the credit markets. What does that mean for the economy?
Well, it means that the economy is going to grow less because of the stimulus than otherwise. If only 1/3, about 600 billion is spent, that's about 3% of GDP as opposed to something that is closer to 10% of GDP. So there'll be some growth acceleration relative to a baseline without the stimulus, but not as large. And if the money then is recycled and saved in financial market, then I think that the worries of the bond market that the yields are going to go much higher may be proven ex post incorrect, because I think bond markets are worrying that now most of the money is going to be spent. And as I pointed out, if you're saving it and running out your debts and your arrears, then rise in non-performing loans, rise of defaults of households on the variety of their loans, mortgages, credit cards, student loans is going to be less than otherwise. And you could have further tightening of, say, spreads in the credit market as well. So those are the implications of it.
But it's not too excessive.
Well, based on 1/3 spend and 2/3 being saved, it would not be excessive in terms of the concerns of folks like Larry Summers or Olivier Blanchard that is going to lead to a overheating of the economy. The part that is going to state and local government is going to be mostly spent, but most of the transfers are going to be effectively to household sector. And I think many households, in order to stop losing their homes or being evicted or foreclosure, they'll have to save the money and use it to run down their debts and their arrears. And that's what economic and empirical studies suggest. So it looks like huge on face value, $2 trillion, but the amount that is really spent is going to be only a fraction of it. So it's not excessive.
Nouriel, switching topics
standard.
just a little bit, though, we also want to get your take just on the SPAC raise and what we've seen play out in the markets over the last several months. We saw a record month for SPACs in January, on track for another record month in February. Is there any risk, do you think, to this?
Well, I mean, the SPAC phenomenon is, my view, as a broader signal that there is, with zero rates on the short end and very low on the long end, there's a mass of liquidity, and the short run is not leading to goods or service inflation, is leading to asset inflation and eventually to asset bubbles. So whether it's tech stocks or the fact that cyclically adjusted PE ratios are well above historical average at 33, whether it's the bubble in cryptocurrencies, whether it's the SPAC phenomenon, some of it is a signal of this frothiness in financial market because money is so cheap and everybody can borrow and do the investments that may turn out to be good or bad. Some of these SPACs investment might go for the right companies and be high return. Some of them, given there is frothiness, are going to end up with disappointing returns for the investors. So I don't think that all of them are going to be successful. I don't think there's systemic risk coming from the SPAC, leaving aside the fact that maybe there is excessive frothiness in financial markets and eventually a correction is likely, especially if, in my view, some of the tail risk of the economy is going to imply that probably the economy is going to grow slightly less than what the markets are expecting. The market are expecting a V-shaped recovery. I think there are many reasons that could elaborate on why the growth might disappoint to the downside rather than to the upside.
Nouriel Roubini is a professor of economics at New York University's Stern School of Business, also CEO of Roubini Macro Associates. Thank you, as always, for joining us. And Nouriel LaRoche, thank you for being here as well.